Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Tony Zhang, Chief Strategist at Options Play, for an update on the U.S. options market and strategies to trade key themes. And Tony, the question everyone is asking is, have we reached a market top for the time being after a phenomenal V-shaped run off the March 23rd lows?
Yeah, so first of all, I think we should actually take a look at the Nasdaq 100 index to try to help answer that question, because the Nasdaq 100 has been leading this market higher. It is substantially different than what we're currently seeing in terms of the S&P and the Dow. And if we look at the Nasdaq 100 index, it had a phenomenal run. It managed to break above 10,000, pull back, and now we're back above 10,000 again. Now, there is quite a bit of negative divergence that we're currently seeing on the charts, both the weekly and the daily charts. But the one thing I will say is that due to the negative divergence, we certainly see that there's a higher probability of pullback. But what the thing about negative divergence is that it can remain that way for a period of time. As we saw back from November to February, that remained overbought and overextended, and we saw some negative divergence for months on end. So just that in itself doesn't necessarily mean that we're a market top, but there certainly is a higher probability right now of a pullback. Now, one of the things that I've talked about here on Trade Talks a couple of weeks ago, which was the fact that the market rally from the March bottom predominantly has actually been fairly healthy. Meaning, if we look at the equal weight index, if we look at small caps, they were all joining in on the rally. They actually led the market higher for the most part. But over the past couple of weeks, we have started to see these sectors lag. Both equal weight, the S&P 500 equal weight index, as well as small caps have started to lag. So S&P is down about 2% today. Those are down 3 to 4% today. So those are all some of the indicators that we're currently looking at that are concerning of markets as they reach these all-time highs, that suggest that perhaps a pullback is starting to materialize. Exactly.
Yeah.
But the one thing that we do want to point out is that there are some major support levels that we are still above. So our base case at the moment, especially with the Fed continue to pump liquidity into the markets, is the base case is still looking to buy these dips. But if we break below some of these major support levels, that's when we want to shift our views to more bearish views at the moment.
All right, and on the other side of that is the performance of the 6 mega cap tech names, as you had mentioned before, and also the biotech sector hinging on hopes of COVID-19 treatment.
Yeah, so one of the biggest concerns that we currently also see with the market rally is the fact that such strong concentration in these top 6 names in the FANG index, if you will. And it's led to most of the outperformance of the Nasdaq 100 index, the S&P, and dragging technology higher. And these 6 names now account for 24% of the S&P 500 market cap. So out of 500 names, 6 names are taking almost a quarter of the market cap. That's concerning. But again, just because this one metric is not a good reason to go out and short this market or necessarily even say that this is a market top. This is just something that tells us that when we do get that next pullback, these pullbacks tend to be fairly violent when you do see market caps reach these types of extremes. And on the biotech side, this is really one of the bright spots that we currently see in the markets that we don't think necessarily is as overbought and does have a lot more room to grow to the upside. The IBB Nasdaq 100 biotech index broke out to an all-time high that actually goes all the way back to July of 2015. So this breakout, I think, sets up for a potentially much larger move to the upside here for biotech.
And how about the leisure versus corporate travel picture, which took a huge hit on Wednesday, June 24th, if you're catching this on the replay, with a regional quarantine announced by Governor Cuomo? And how do you trade this? Because if it's just happening New York, New Jersey, and Connecticut, can you imagine if it also goes into a major hub like Chicago, which has really followed our lead before? I mean, think of United Air, where their largest hub is in Chicago, I believe.
Yeah, so travel stocks, that's predominantly been one of the areas where we've seen a lot of volatility over the past few weeks. We saw some airlines have double-digit gains back-to-back a couple of weeks ago, followed by double-digit moves to the downside over the past couple of days. So one of the things that we want to put into context is the fact that if we look at the amount of travelers that are traveling by air, one thing to remember is that that's still down 80% from the same level of last year. So the moves that we saw from the airlines a couple of weeks ago, I felt was a little too far too fast, and markets have come back from that. But the one thing that we want to also point out is that despite this recent growth in terms of travel, that we've seen a bifurcation in that travel between leisure travel versus corporate travel. So leisure travel has actually recovered almost 50% from last year's from the trends that we saw from last year, but corporate travel is still down almost 90%. Businesses are not traveling. So this is one of the things that you want to pay attention to as you're thinking about playing airline stocks or even some of the cruise stocks, is that leisure travel certainly starting to come back. So if you're thinking about domestic discount airlines like Spirit, like Southwest Airlines and Allegiant, those are the names that I would pay attention to or see a bit of strength in. And then the legacy carriers, Delta, United, American, those are the ones that I expect to see more move to the downside. And we're seeing that in the markets here today. Those are the legacy airlines are down substantially more than the domestic carriers. And also, on the next trade idea, corporate travel, there are some names that are fairly exposed to the corporate travel. And those are the names that I really are looking for some bearish opportunities in.
Now, how about the biotech trade?
Yeah, so we can look at biotech. So the IBB, well, as I was saying, IBB broke out above that 133.5, 135 resistance level, which again goes back to July of 2015. So this sets up for a much bigger move to the upside. So for this type of trade, what I'd usually like to do is to use a debit vertical spread, especially when we talk about markets potentially being at a top and probability of pullbacks being higher. We want to protect ourselves to the downside as much as possible. So debit vertical spreads here are an ideal candidate here. So what I'm looking to is to go out to August, give myself a little bit of time for this trade to work out. I'm looking at the 140, 155 call vertical. So this is a 15-point wide debit spread that I'm paying about $4.80 for, just about a little under a third of the width. And the play here is to really look for a breakout here on IBB and for that to continue moving higher, especially the fact that it reached 140, came back to retest that 136 level today. I think this is a really good, attractive risk to reward for a long position here, and risking only $480 on $140 ETF means I'm only risking about 3% of the underlying stock price. Even if markets correct and start moving lower, no matter what happens, I'm only risking 3%. And the upside that I have here is almost $1,000 gain to the upside. So almost a 2-to-1 risk to reward ratio if IBB does break out and continues to move higher.
And let's wrap with the trade in gold, which has had a remarkable run along with equities, which is typically unusual. You don't see them running in tandem with each other as much.
Yeah, I definitely would say that the gold rally and the breakout we've seen over the past couple of days above that 164, 165 level is more in line with the dollar weakness that we've seen. So dollar index seeing a bit of a decline over the past couple of days. Same thing in TLT. So dollar certainly weaker, and this is bullish for gold. This is more of an inflation hedge against some of the monetary policy that globally we're seeing right now, and gold is being priced in dollars. So looking at this breakout, same type of trade here. I'm looking for a breakout. I'm using a debit vertical spread going out to the July 31st weekly options, giving me about 45 days to expiration. I'm trading the 166, 175 call vertical here, paying only about $2.59 for roughly a $9 wide debit spread. So again, a little under 20-25% of the vertical width to pay, because this way, no matter what happens, again, even if gold declines here, I'm only risking less than 3% of the underlying ETF's value to play for almost a 2-to-1, a little more than 2-to-1 risk reward ratio if gold continues to move higher.
All right, Tony, to wrap up here, tell us about the special offer for Trade Talks viewers.
Yeah, so thank you so much for having me. If you are interested in taking a look at the options play software, which is what I use to find these trades and structure and analyze these trades that I showed you, you can sign up for a free 30-day trial at trade.optionsplay.com/tradetalks. It'll give you access to the platform, online education, as well as weekly income reports to help you find ideas for how to generate income utilizing options.
All right, Tony, great stuff as always. Thanks so much for joining me on Trade Talks.
Thank you so much.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.